Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Investing in commodities ETFs can add balance and diversification to your portfolio, especially when traditional stocks and bonds aren't performing well. These funds track a basket of raw materials like oil, metals, and agricultural products, offering exposure without the hassle of trading futures contracts. One of the most popular options, DBC, Invesco D Commodity Index Tracking Fund, gives investors broad access to multiple commodities in a single trade. Whether you're looking to hedge against inflation or simply diversify, commodities ETFs can be a straightforward way to tap into this market. In this video, we'll cover how they work, why they matter, and what makes DBC a go-to choice for many investors. Understanding commodities ETFs. Commodities ETFs give investors exposure to raw materials like oil, gold, or wheat without needing to trade futures or store physical assets. They bundle multiple commodities into a single, tradable fund, making it easier to diversify across this market. While they track the price movements of these goods, their structure is different from stock ETFs, and that's where things get interesting. What are commodities ETFs? These are exchange-traded funds that track the performance of commodities, either directly or through derivatives like futures contracts. Instead of buying barrels of oil or bushels of corn, you buy shares in a fund that does the heavy lifting for you. For example, broad exposure funds like DBC track a mix of energy, metals, and agricultural goods. Single commodity ETFs focus on just one resource, such as gold, GLD, or crude oil, USO. Futures-based ETFs don't hold physical assets, but instead invest in futures contracts to follow price trends. Unlike stock ETFs, which hold actual company shares, commodities ETFs often rely on complex financial instruments to mimic price movements. How do commodities ETFs work? Most commodities ETFs don't hold the physical goods. Imagine a fund trying to store thousands of barrels of oil. Instead, they use futures contracts, which are agreements to buy or sell a commodity at a set price and date. Here's the catch. Rolling contracts. ETFs constantly replace expiring futures with new ones. This can lead to roll yield, where costs or gains from switching contracts impact returns. Tracking error. Since futures prices don't always match spot prices, the ETF's performance might differ from the actual commodities price. Diversification. Funds like DBC spread risk across multiple commodities, reducing the impact if one market drops. This structure makes commodities ETFs accessible, but it also introduces nuances that don't apply to stock or bond ETFs. Commodities ETFs versus physical commodities. Why choose an ETF over owning the actual commodity? Let's break it down. Convenience. No need to arrange storage or handle logistics. ETFs trade like stocks, so buying and selling is instant. Cost. Storing gold or oil isn't cheap. ETFs bundle these expenses into their management fees. Liquidity. Selling a futures contract is easier than finding a buyer for 100 barrels of oil. However, physical ownership avoids the complexities of futures contracts. If you buy gold bars, you're not exposed to roll yield or tracking errors, just the market price. ETFs simplify the process, but they come with trade-offs depending on your strategy. The next section will dig into the pros and cons of investing in these funds, so stay tuned. DBC, a case study of a diverse commodities ETF. DBC, Invesco D Commodity Index Tracking Fund, is one of the most widely recognized commodities ETFs, offering broad exposure across energy, metals, and agriculture. It's a go-to for investors who want diversification without the hassle of managing multiple futures contracts. Let's break down what makes DBC stand out. Overview of DBC. Launched in 2006, DBC tracks the DBIQ Optimum Yield Diversify Commodity Index. Unlike single commodity ETFs, it spreads risk by holding futures contracts across 6 major commodity sectors. The fund rebalances annually and adjusts exposure to minimize the downsides of contango when futures prices exceed spot prices. With over $2 billion in assets, it's a liquid and cost-effective way to tap into commodities. DBC appeals to investors who want inflation protection, as commodities often rise when consumer prices do, prefer a hands-off approach to trading futures, seek diversification beyond stocks and bonds. Key holdings in DBC. DBC's portfolio is weighted to reflect global demand. Here's a snapshot of its top exposures. Energy, WTI crude oil, Brent crude, gasoline, and heating oil. Metals, gold, silver, copper, and aluminum. Agriculture, corn, wheat, soybeans, and sugar. This mix means DBC isn't overly reliant on one commodity. If oil prices drop, gains in gold or crops can soften the blow. The fund's allocation shifts slightly each year, but energy typically dominates due to its market size and volatility. Performance and historical returns. DBC's returns hinge on commodity cycles. It surged during the 2008 financial crisis and the 2020-2022 inflation spike, but lagged when oil crashed in 2014 to 2016. A few key takeaways. Long-term trends. Over the past decade, DBC has averaged around 2 to 4% annual returns, though past performance doesn't guarantee future results. Volatility. It's more erratic than stock ETFs, with swings tied to geopolitical events, weather, and economic shifts. Correlation. DBC often moves differently than stocks, making it a useful portfolio diversifier. For investors, DBC works best as a tactical holding, buying during inflationary periods, or as a hedge rather than a long-term core investment. Fees, 0.85% expense ratio, are higher than stock ETFs, but that's typical for commodities funds handling complex future strategies. If you're considering DBC, assess your risk tolerance. Commodities can zig when stocks zag, but they're not for the faint of heart. Benefits of investing in commodities ETFs. Commodities ETFs like DBC offer several advantages. Whether you're looking to diversify your portfolio, hedge against inflation, or simply gain exposure to raw materials with minimal effort, let's break down the key benefits. Diversification and risk management. Commodities often move independently from stocks and bonds, making them a strong diversification tool. For example, while stocks slumped during the 2008 financial crisis, gold and oil prices surged. Holding a fund like DBC adds balance to your portfolio because low correlation. Commodities tend to rise when traditional assets fall, reducing overall volatility. Spread exposure. A broad fund mitigates risk by blending energy, metals, and agriculture. If oil prices drop, gains in gold or wheat can offset losses. Historical data backs this up. Between 2000 and 2022, commodities had a near-zero correlation with the S&P 500, proving they don't follow the same trends. Commodities ETFs can add balance and protection to your portfolio. Stay tuned for Part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.